Thanks, Greg, and good afternoon. I know I stand between you and whatever's next in your life, which is out of this building, I suspect, so I'm going to get right to it. A couple exclamation points. Casey Crawford is the real deal. I've gotten to know Casey. We have shared several things together. NCF, as just mentioned. Movement Day Charlotte. I actually will be with Casey next Wednesday, but he's a great example of a young guy who's done really well in the athletic world and therefore financially, and is using his life for the Lord, which is really great to see. So I greet all of you, many of you friends over time, whether it's Kingdom Advisor or NCF or other associations that we have. It's always a privilege to come to speak to brothers and sisters about both things temporal and things eternal. In talking about how to get this thing going with Brad, he said, you've got to share your thoughts on the market. So I'm going to start there and spend the bulk of my time, and I'm going to try to limit myself, yeah, I'm watching that clock, to 25 or so minutes on that, spend 15 or so on generosity, and I've done that before in this very room. This time I'm going to make it a little more personal, some personal anecdotes that are hopefully helpful to you in your stewardship and generosity journey. And I also hope to leave a few minutes for questions. So let me describe, for those of you who I don't know, I'm an equity portfolio manager. I spend 80 to 90% of my time picking stocks, trying to own the good ones long and the bad ones short. And my team and I have had some pretty good success celebrating 5 years track record at Nuveen in June, with 3 of our funds getting 5 stars. It's always a good thing to have. So out of that stock picking come our macro thoughts. So it's not like we sit around Thursday afternoon saying, I wonder what the world looks like. Instead, it's every day as we're in the markets talking to companies, CEOs, CFOs, division heads, that we spot trends and put them together with some macro thoughts. So let me summarize up front, show you a few pictures. The equity bull market in the United States, in my opinion, is not over. Is it in later stages? Yes. But it's nowhere near over. I find a lot of people, because the business cycle and the bull market has been going on for a long time, want to ask the question, how long is this going to last? Almost implying that the business cycle or the bull market is old, using a cane to get around, kind of short on breath, maybe in a wheelchair, you know, kind of ready to keel over and die. CFA 101, do not spend any time trying to look at how long a bull market or a business cycle has been in existence to figure out how much longer it's going to last. There is no correlation, zero. The temptation on all of our parts is to use actuarial tables. See, because we use actuarial tables consciously or unconsciously for human beings. The old people we expect are going to die, and the young people we expect are going to last a long time. That's an actuarial table. Business cycles, quite the contrary. The amount of time it's been around has no predictive power on how much longer it's going to last. Related to that, I often get the question, Bob, when's the next recession? To which I say, number one, I have no idea. And no one who tries to tell you has any idea either. However, we all have, number two, our opinions. And here's my observation. The amount of time from the inversion of the yield curve to the onset of bear market has averaged about 9 months. And from the onset of bear market to the onset of recession has averaged about 8.5 months. Allow me to say 9 to make the math easy. So if you put a gun to my head and say, Bob, you have to tell me, when's the next recession going to happen? My best guess is about 18 months after the yield curve inverts, which anyone's in this business knows We're just not there. So we got a ways to go. Some people press it and say, okay, well then what inning are we in? And my standard answer these days is probably about the 7th inning, but this ball game, they may very well have extra innings. I just don't know how many. So the stock market in the U.S., I would argue, has a major tailwind and some modest headwinds. And given I use that language, I believe the tailwinds are appropriately overshadowing the headwinds. Let me try to enumerate. Tailwind. Perhaps no surprise to you, the massive tailwind we have is earnings. The U.S. economy is in great shape. Is it perfect? No. Let me say it this way. The risk of overheating in our economy is higher than the risk of recession. We are witnessing the strongest real and nominal growth in this business cycle, the strongest growth we've seen in a decade and a half. That tailwind, to put some numbers on it, earnings growth in the first half of this year, as you undoubtedly know, was about 25%. Let me pause there. That an economy as big and mature as the United States can generate 25% earnings growth is amazing. You know, off a recession-depressed earnings low, 25%, yeah, that's normal. But in the 9th year of a business cycle, unheard of. To which the bear says, yeah, Bob, it's all about that tax bill. I beg to differ. Do a little analysis. We calculate about 1/3 of the earnings growth has come from the tax bill. So earnings growth would be 17 or 18 without the tax bill. About 1/3 from extraordinary revenue growth. And the remaining 1/3 roughly from profit margin improvement and some financial engineering. So it's big and it's broad and it's rich. That's the good news. There are other good news things, but time doesn't permit me to go into all the details. I would argue it this way. Why, to take the other side of the coin, if earnings are up 25%, why is the stock market not up 25%? Stocks, as you know, year to date, to use round numbers, up about 10%, which means valuation levels or PE ratios are down 15%. What's that all about? Aha, therein lies the modest headwinds. Classically, modestly higher interest rates and inflation put pressure on PE ratios. And we've seen some of that, and we will see more of it. I'll use the language that inflation and interest rates in the U.S. have moved from very low to low. So what's on the list of minus 15 PEs? Well, it's a long list. I mentioned interest rates and inflation. The other issues are headed up by trade and tariffs. So let me spend an extra minute there, and I'll leave all the other issues to the Q&A or to another day or till you'll see me afterwards. So without being too long-winded, I think this is an important digression. When President Trump got elected, I said to myself, I don't understand this man, and I'm a portfolio manager and a fiduciary to every one of my clients. I need to understand how he thinks and how he's likely to govern. So I did two things. First thing I did was read his book, The Art of the Deal. If you're confused by President Trump, whether you like him or not, read the book. It's a quick read, and my conclusion is everything with this man is a negotiation. Business, politics, people. And when he thinks something should be here, when it's here, he doesn't argue for this. He argues for this. You get my point? And works his way back. I'll come back to that when it comes to trade and tariffs. The second thing I said to myself is, Bob, this man doesn't seem to stand for anything in particular. He just likes to win, with one glaring exception, trade. He wants free and fair trade, and he's going to punish everybody to get there. So the second thing I said is I've got to find some trade experts to educate me so I can better understand what this is about for this man. It took me a long time, parenthetically, to find a couple of trade representatives that could educate me. Most of the people I found either leaned left or right, and I was not interested. I wanted to find somebody to educate me, if you get my point. They have convinced me that a tariff is a tax. And when you tax something, you get less of it. Therefore, no one wins in a trade war. Oh, there are relative winners and relative losers, but no one's an absolute winner. It's sort of like if Brad and I have a fight afterwards, because Brad said, you didn't cover what I asked you to cover. And he ends up with a black eye, and I end up with 2 black eyes. We were both worse off than we were, but he's a relative winner. Do you see? He only got 1 black eye. China needs us more than we need them. And the president and the administration believe that, and therefore will continue to punish China. So back to trade was here. He thinks it should be here, but we're starting here. He threw everybody under the bus, did he not? And now we've made a conceptual agreement with Mexico. By the way, the difference between our tentative agreement with Mexico and NAFTA is about that much. You can hardly see it. But they're going to say, yeah, we fixed it, right? They're politicians. I believe we will come to similar conceptual agreements with Europe. We're close. Japan on autos, we're not too far away. Canada's proving to be a little more problematic, but I think that will happen too. The president will eventually say, give Trudeau what he wants, I want it done. So that he can step back and call President Xi, say, Mr. Xi, I can do trade deals. Look at the 4 we just did. It's your turn. That's what this is about. These trade representatives also convinced me that most of the world operates with free and fair trade, with the notable exception of China and intellectual property. That's what this is about. Markets hate uncertainty. That's why this is a negative for the moment. We've had 6 straight years of PE, or valuation expansion. That is to say, on December 31st, in each of the last 6 calendar years, the price-earnings ratio for the stock market was higher than it was on January 1st. 6 years in a row has never happened before. And we do these silly 10 predictions every year. One of them was, we're going to break that, unfortunately. That is, stocks will be up this year, but less than earnings. And that's proving to be the case. So for the last 6 years, I might say it this way, we got spoiled. If you bought a stock, the decent economy took it up with earnings. If that didn't work, PEs took it up, and for most stocks, it was both. Now we're in an environment where the earnings have to be there. Just think of the last quarterly earnings report. Many companies reported better than expected earnings. The stocks kind of sagged because of the PE pressure. So from here to the end of the bull market, it's about earnings, and that could go on for a long time. So that's my long-winded introduction. I'm going to show you a few pictures. When it came time to do the predictions for this year, and I'm still of this view, therefore in September I can still act this way, we have moved from a nearly perfect to a less than perfect world. To refresh your memories, 2017 was the only year in U.S. history where the stock market, as represented by the Standard & Poor's 500, had a positive return every month. Never happened before. By the way, I took this series of returns to a math geek friend. I said, what's the probability that can happen again? He said, I can't believe it happened once. The probability is about as close to 0 as you can find it. So we lived through a positive fluke, as he calls it. Now we're in a less than perfect world. Less than perfect's not bad. It's just not nearly perfect. Stock's up every month, up 21%. I've tried 15 different ways to illustrate the difference between a nearly perfect 2017 and a less than perfect year in which we find ourselves. I won't insult your intelligence by reading all these, but let me pick on inflation and interest rates, which we argue last year were very low and benign. perfect for the stock market. This year, we're arguing inflation interest rates low. Low is higher than very low. Don't miss that nuance. And rising. Not horrible, but you see, less than perfect. That's the world in which we live up and down the page. Biggest risks, I've already covered protectionism in my long diatribe about tariffs. Inflation, I just argued, again, I'll use qualitative language. Inflation has moved from very low to low. Bad news for bonds, good news for stocks. If inflation continues, which it usually does, to move from very low to eventually middling, it'll eventually be negative for stocks, but we're not there yet. China. China represents almost half of the incremental GDP growth to planet Earth this calendar year, 45% for you data geeks. So when China slows, it has an issue for the rest of the world, which it did in the first half. China is re-stimulating concerns about the tariff, and you know the emerging market story, which I don't have time to illustrate. The business cycle in the United States is represented by the blue line at the bottom. Is the slowest economic advance in history, despite its recent acceleration. And if it lives until next June, will become the longest business cycle in the US. You probably know that. Mid-August represented the milestone where the bull market in stocks became the longest bull market in US history. The bottom half of this slide is wage growth. Let me pause there for a minute. The biggest conundrum for me this business cycle has been that we've gotten unemployment down to under 4%, and wage growth has hardly budged. And you all know the reasons: globalization, technology, there's some demographics in there. But if you look with me at that bottom half, this is roughly the last 30 years, you can see when wage growth gets to be 4%, which I use as one proxy for inflation, that's usually when it stops going up and comes back down the other side. How does that magically happen? Answer, I can't prove this, but I think when inflation in wages gets to 4%, the alarm bells go off in every Fed building in the country, which is a signal to all the Fed employees to go in that little closet behind the side, pull out the clubs, and beat on everything you can, hoping to beat on inflation and pushing it back down. As you see on this slide, they are successful every time. The problem is they beat on inflation and everything else and put us in a recession. This slide goes to the end of this last year. Coming into the year, wage growth 2.6. Through the most recent monthly employment report, 2.9. Yeah, we're edging higher, but we're nowhere near 4. Not that 4 is a guarantee for what you need for a recession, but is among the reasons why I believe this business cycle is nowhere close to over. Interest rates. Finally, the 10-year yield is up above 3 again. If you look at a long-term chart, these things take a long time sometimes. To refresh your memory, the 10-year Treasury yield in 1981 was 15%, and on July 8th of 2016 was 1.37%. So rates fell by 90+%, generating the biggest bull market in bonds and stocks that look like bonds in our careers, in our lifetime, in my judgment. Among the reasons yields got to 137 on the 10-year Treasury, I'd highlight 2. 1, interest rates in other parts of the world were below 0, putting downward pressure on our rates. And number 2, the central bank. The Fed, as you know, bought well over $1 trillion, several trillion, that's with a T, dollars of bonds. Question, if somebody buys $1 trillion worth of bonds, do you think they have an effect on the price of that bond? You bet they do. Somebody walked in that door and says, I'm going to buy $1 trillion worth of bonds. You know the price of the bond's going up, which means the yield's going down. That's how we got to 137. And now we're on the other side of it, and they're selling bonds. And when that happens, they have a similar opposite effect on interest rates. They push the price of that same bond down and the yield up. We make this all so complicated. Interest rates are heading irregularly higher. CapEx. If you know anything about this business cycle, you know capital expenditures on the part of corporate America have lagged big time in this cycle until the passage of the tax bill, and now in 2018 we're seeing renewed capital expenditures. One of the problems we have in this country, economically, in my judgment, is a productivity rate that fell to 1%. We need to get it back toward 2%. And the tax bill gives us the first chance, no guarantee, first opportunity to take it back up. And if you look at this chart, you can see it's begun to move back up. A 2% instead of a 1% productivity rate solves a lot of problems. I wish I had time to go into it. Inevitably, in a Christian crowd, I get all the time, what about the debt? Far more than in a secular crowd. The federal debt and the federal deficit at the moment does not matter. Period. Full stop. Now, I know what the good book says about debt. But I also know when interest rates are low and the economy is improving, nobody, this is on page 22 of the newspaper. Until this is on page 1, it will not matter. Yes, we are setting up a problem for ourselves. I get it. This will matter at some downturn. I don't think the next recession, maybe the one after, maybe the one after that. Because we'll get to a point where we just can't get out of it and we can't grow. And then it'll move to page 1 and then we'll fix it. America does not solve its problems till its back's to the wall. And when it does, we're actually pretty good. It's not fun, it's messy, it's ugly. Let's take Social Security. This is all about the entitlement programs, by and large. Social Security, we can fix on the back of a 3x5 card. You step on toes to do it. You delay the start of receipts, you do a little means testing, and you lower the rate of increase. Did I step on everybody's toes already? That's what you got to do. It's that simple. Look, when Social Security was put in, we had this many workers for every retiree. Now we have this many workers for we just can't afford it. It's period simple. And I always get the question, well, then why don't they do something about it? They being, of course, Congress. The answer is because we tell them routinely not to. When Americans are surveyed on this issue, do you want your congressperson to fix the debt and the deficits? Americans' answer is always the same. 72% of us say, of course I want them to fix it, but don't touch mine. And if you do, I'm going to kick you out of office. Until that changes, they're political animals. They're not going to touch it. So I'm optimistic. We'll fix it when it's on the first page of the newspaper, and not a minute before. So let me start wrapping up this piece. I want to spend a couple minutes on how I'm positioned in my portfolios and then transition to the more important part of the agenda, maybe? I don't know. We would argue 7 points. 1, overweight stocks. But recognize stocks are the best house in a deteriorating neighborhood. I believe returns on stocks, bonds, and cash will be below their long-term averages over the next 1, 3, and 5 years. Therefore, number 2, focus more on alpha, less on beta. For you financial advisors, you know last year was a beta environment. Stocks were up 21%. A good manager was up 24, a bad one was up 18. Who cares? Everybody's making a lot of money, right? Different story this year. June 30th, I did a lot of work on this subject. S&P 500 was up 7 for the first 6 months of this year. We were fortunate, our large cap core fund, to be up 12. And I found some managers who were down. We just own a lot of dividend and dividend growth stocks, the worst performers. Do you see my point? What you own and what you don't own in an asset class is more important than the return on the asset class itself. So the question these days, in my view, is not how much should I have stocks, how much should I have in bonds. It's which stocks should I own, which stocks shouldn't I own, which bonds should I own, which bonds shouldn't I own. I just gave you the equity illustration. Some lost money, some made double digits. Bonds, the same thing. If you've been in munis so far this year, you're doing okay. If you've been in treasuries, not really. You see, this is an alpha world. Number 3, if you agree with my quick assertion earlier that interest rates are going to continue to move irregularly higher, beware of the interest sensitivity in your portfolio. Beware of treasuries, beware of duration, beware of yield stocks, beware of dividend growth stocks. 4, watch inflation carefully. Inflation rising is the worst enemy of the financial markets, just like inflation falling is its best friend. I wish I had time on number 5. I'll say it this way. We would be diversified geographically, but retain an overweight to the United States. So many home offices have said overweight non-US. I don't understand why. Oh, because they're cheaper. No, they're not. Don't let anybody tell you that the US stock market is cheaper than Europe. Sorry, the other way around, that Europe's cheaper than the United States. Our stock market's always more expensive because we have more growth companies. You have to sector adjust for neutrality and ease of comparison. When you do, you will find the US is cheaper than Europe. 6, another reminder, mediocre total return. 7, consider an absolute return product. I have the privilege of managing an equity market neutral fund, beta of 0, designed to go up a little bit all the time. If you wait until a bear market to say, how am I going to make money for my clients, it's too late. You got to start doing some homework, do some experimentation, and an equity market neutral fund properly managed can give you an up market and down equity environment. John Templeton, I am sure you've seen this quote before. Bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. Last time I had the privilege of being in this room, and if I've been in any of your offices and at KA in Orlando, I've used this very slide. For 6 years, I had grow on skepticism bolded. We lived through a long period where people were skeptical. The best time to own common stocks historically is when the world is skeptical, when your clients are skeptical. Markets love to climb walls of worry. Effective January 1st, I moved the bolding to mature in optimism. Now, I'm not making the case the skeptics are all gone. There's still plenty of skeptics out there. But we've got some optimists now, too. Corporate CEO confidence is at an all-time high. Small business confidence near an all-time high. Consumer confidence near an all-time high. Somebody's turned optimistic. If that's accurate, what it means for the stock market is stocks are still the place to be, but the rate of return is lower and it's bumpier. And that's the world in which I think we find ourselves. I have the privilege of managing U.S. large cap, quantitative, and fundamental research as our investment process. These are the 5 products that all this talk I just gave you fit into. Large cap core is our flagship fund. We have a value and a growth fund, all betas of approximately 1. Equity market neutral is a beta of 0, an absolute return product, and equity long short a tweener. Time doesn't permit, nor is it appropriate at this juncture for me to go into that in any more detail. But let me see how we're invested. This will kind of wrap up my thoughts on the markets. 5 themes in our portfolios. If you will, 5 positives, 5 negatives, 5 overweights, 5 underweights, 5 longs, 5 shorts, and they come in pairs. Pair number 1. We believe economic growth here in the U.S. and earnings growth, more importantly, is pretty good. Better than pretty good. And outside the U.S., reasonably good, fraying at the edges a little bit. Accordingly, we want to be overweight companies exposed to the economic cycle. We want to be cautious about the number of recession beneficiaries we own. Wrong time in the cycle, and those stocks are expensive. Theme 2. We are big believers that free cash flow is a differentiator between good and not so good stocks. We want to own the former. We want to be short the latter. Question, what are these companies doing with their free cash flow? Earlier in the cycle, we would say, give me a dividend increase or a share buyback. We're off that kick. Now we want to own companies that benefit by reinvesting their cash. Show me you can grow. Theme 3, we have the privilege of being 4.5% ahead of the market as we speak. Almost half, 2 of that 4.5 came from this third theme. We have owned companies that get most of their business here in the US, meaning we're underweight the multinationals. Bunch of reasons why. The tax bill, benefiting domestic earnings. 2, the trade issue, hurting the multinationals. 3, earnings surprises, accruing more to the US than the rest of the world. And 4, currency. When the dollar goes up, you want your earnings to come from your home country. Theme 4, I already alluded to. We want to own companies that benefit from rising rates. We do not like companies that benefit from falling rates. They had years of success. To repeat, dividend stocks and dividend growth have been the worst stocks since the middle of 2016. I find a lot of advisors scratching their heads. They fell in love and married these stocks. Yeah, a lot of them are great companies, but a great company does not make a great stock. There are stocks that look like bonds. Finally, from a sector standpoint, we like what I call the chicken cyclicals. Selected consumer discretionary, we own some tech, footnote, prefer value tech to growth tech at this juncture. Some financials, we own a little energy, some healthcare, we, to repeat, don't like the expensive defensive stocks. So I hope that's helpful to wrap up these market comments. So let me switch gears. I think I said last I was here, I will say it more emphatically now. If you or your clients have money to give away because you've done so well in this bull market, enjoy the benefits of your tardiness. And bring the cash register and give some of that money away. I've talked in this room about principles of generosity, and many others have too. So I'm going to give you 7 personal anecdotes to sort of back up maybe the things you thought about. Developing a habit. My first introduction to generosity was in junior high and high school. I served a daily newspaper for 6 years. Had 4th of July and Christmas Day as a holiday. 363 days we delivered a newspaper. And my parents instructed me, taught me, to give 10% away. 10% to our local church is what I did. Put 80% away for college, and at least 10% for me to spend on myself. Well, I learned to tithe. It wasn't the joy of giving. Believe me, it was a check-the-box exercise. Only the joy came later. My point isn't don't develop habits if there's not joy in them. Habits can be good habits. Going to church can be a habit. Reading the Bible can be a habit. And it can be a check-the-box exercise. But you know, God often, in some other way, brings the joy. Develop a habit. Simple, but I hope helpful. Number 2. I credit my wife, Leslie, on this one. We would do our giving, far too much of it in December. And we'd sit across the table from each other, and it was not fun. You know, she'd want to give this much, I'd want to give that much. She always said, let's give to this many organizations. I'd say give to this many. I mean, we went round and round and round. And she finally said, you know, I'm tired of writing checks. It's time to get involved. This started, 20-ish years ago. And I would say for all the major giving that we do, we are involved. Some way, shape, or form. As Brad and some others knows, my wife heads to the Middle East to try to see Muslims come to Christ. She goes 4, 5, 6 times a year. I am privileged to have involvement in a bunch of different faith-based organizations so that we can not just write a check. We're still writing checks, but hopefully give a life. I hope you are there too. God wants not our money, he wants us. That's another way to put it. 3, I don't know if this speaks to anybody, but we woke up one day and found out I was so busy working and Leslie was so busy bringing up our kids that we did not have a conspicuous consumption problem. We didn't have time for it. We had an inconspicuous savings problem. We were building barns of money and bank accounts. And we woke up and said, you know, it's time to get serious. So we were generous during that period, but we were mostly giving out of income, and we learned during those days you got to give out of wealth too. More about that in a minute. Number 4, make it fun. I don't know what you do. A couple of things we like to do. One of the organizations we're involved with, there's what's called the Director's Contingency Fund. And we fund this thing every year with a bunch of money, and it is for the director, the executive director of the organization. This organization has a lot of foreign missionaries, to give when they need something. You know, there's a health issue, parent dies and they got to fly back for the funeral. They just don't have the money. They have no idea that it's us. But they write these nice notes to the executive director, which he passes on us. The blessing that comes from that, I suspect you all could tell stories like that. If not, find a cause to do that. My wife likes to, when we're at a restaurant, pay for somebody else's meal. Maybe you do that too. And you kind of watch when the waiter or the waitress comes over and gives them the check, and you know, we don't tell them who it is. Just say it's in the name of Jesus. Make it fun. 5, be open to the Spirit's moments of challenge and invitation. Some of you may have heard me tell this story before, but it was a bunch of years ago. Leslie and I were invited to a friend's home for Saturday night dinner that was to be a fundraiser. The president of the organization was going to be there making the pitch. We got there and found out we were the only people. The host family and us. So it was all directed at us. Well, that was a bit of a rude awakening. We discovered, my wife and I, after the dinner, that we both had a number in mind that we were going to write the check for this cause. And it turned out it was exactly the same number. And when it came time for the president of the organization to make the ask, he asked for a number from us. It was that number with a 0 behind it. In other words, 10 times the number. And the number we had was, for us, a pretty big number. We walked out of there, shared that we have the same number when we walked in the door, and we looked at each other and we said, you know, this was a Saturday night. We said, if by Monday night the Holy Spirit doesn't put something in front of us, we need to be obedient. Now, I'm not saying we do that all the time or you should do it any time, but there's occasionally something that comes along. The benefit to us, the blessing to us as givers was manifold. We're still counting what God has done to enlarge our ministry and bless it as a result of that one act of obedience. I'm not patting myself on the back. I'm encouraging you to every once in a while step out. Number 6, back to we were giving out of income, not out of wealth. We've changed that tune. We have a plan in place. We hope that when we die, our last check will bounce. We have told our kids what's in it for them. It's not a lot. We don't want to curse them with money. They know that, and the rest to be given away. And we've begun to accelerate it. We were comparing notes. We're the same age. I won't tell you what age we are, but we're getting up there in years. We're not going to be around forever, so we need to accelerate. So it is all gone when we're gone. That's our goal. Not the only way to do it, but that's our particular persuasion, if you will. Number 7, we had the privilege, as we were taught by another couple, to set a cap on our consumption. So our consumption early in life, early in our marriage, was way below what our income finally would support. And what we said is we're not going to raise our consumption by a penny. This is money to be given away. I think God often prospers us not to increase our standard of living, but to increase our standard of giving. Boy, has that been a blessing for us. We need more Christians who take some approach like that. It doesn't have to be identical to what I've said, but not just, here's money, Lord. It's really making a difference. So let me end with 3 points, and there'll be about 10 minutes left for questions on the temporal or the eternal part. The 3 principles I'm going to show you are not new to you. I just want to reinforce them as you think about the day you've been through, the way God has challenged your heart, and your mind, your life, your practice. This is straight from the Bible, obviously the Sermon on the Mount. Don't store up for yourself treasures on earth. Everybody knows that. That's what God said. Many people miss the next part. But do store up for yourselves treasures in heaven. God, using Randy Alcorn language, wants to send it on ahead. That's a very exciting concept, isn't it? Number 2, you know this. It's all over the Bible. God owns everything. The conclusion, I think, is different from some way to look at it. So the question is never, how much should I give? We don't ask ourselves that anymore. The question is, how much should I keep? It's all His, and anything we keep, we're taking away from what He has given us. Now, He wants us to live, don't get me wrong. But I hope the not so subtle message is a lot of Christians are saying, I worked hard for that money. I'm entitled to, well, I'm not passing judgment on what you do with your money. I'm just saying consider that it isn't yours. It's all His. Well, I worked hard for it. Who gave you the brain power? Bingo, bingo, bingo. I'm preaching to the choir, I know, but at the end of the day, I hope these 3 messages help you in a fresh way to walk out of here and say, I'm going to be transformed in this area. Romans 12:2. The third point, this is helpful to me when I struggle with keeping versus giving, is to recognize that this is not my home. I am passing through. I'm a stranger and alien to this planet. When I have a passing through mentality, giving money away gets a whole lot easier. Because when you couple that with number 1 and number 2 on this list, it's not hard. We make it so hard. You know why? Because money and possessions is a hard issue. Did you know Jesus, in the red letter edition of your New Testament, had more to say about money and possessions than He did about heaven and hell combined? Why? Because He knew it's an issue of the heart. If we can get this part right as Christians, we will make a difference. Christian giving and secular giving, percentage of income, hardly a difference. No statistical difference. Shame on us. There's a huge world out there that's watching us, and we're not different enough some days. I feel a sermon coming on. So let me pause there. I hope you've enjoyed the bull market. I hope you haven't missed it by sitting on the sidelines because you're worrying about the debt. It is something to worry about, but later. Bull market's not young, but it's not over. On the other hand, be generous. I hope these 3 principles and those few little personal examples give you a little reason to think about, what does this mean for me? How can I apply it to my life? Questions on the macro stuff, the market stuff, as I like to say, the temporal stuff or the eternal stuff. How can I respond to clarify or fortify or answer a question?
When you and your wife started going through, I guess, more of that process of how you're to give, would you say there was a period of time that it took place for you to not just move forward, but essentially see a change in your hearts about it?
Yeah, and we've not arrived. It is still a struggle. We still do too much of our giving at the end of the year. Leslie is still of the view, if I could give to these 3 organizations and none others, I really know what's happening there, and boy, can I make a difference. And I've not met a charity I haven't loved. So we still have those issues back and forth. Yeah, it's about how God wired us, if I could speak to the brain part of it, but clearly the heart has to develop. And to me, there's nothing more than, no other better way to develop our hearts than to do it. They say, where your heart is, your money will follow. It's the other way around too. Where your money goes, your heart will follow. And there's a combination of the two. So as we've given more, our hearts have gotten bigger and fuller, I think, if I can put it that way.
The last session I sat through was on biblically responsible investing. When you're putting stocks in your portfolio, do you struggle when you look at them through your Christian lens, and how do you reconcile that?
Yeah, great question. So it depends who the client is. If I decide, let's pick on tobacco. If I decide tobacco is not a good thing, but I think Philip Morris and Altria are going to be the best stocks, for my secular clients, where there's a signed piece of paper that says your job is to beat the S&P 500 using everything in the S&P 500, I cannot make that judgment. I gotta buy Philip Morris. Do I like it? No. Do I pray about it? Yes. If I have a chance to share with somebody, a client, yeah, I'll do that. I have the privilege of also managing, for 1 cent, some biblically responsible money. There, we've got a list. We're not going to do this, and we're not going to do that, and we're going to favor the other thing. There, I can exercise all of that. So that's how I have reconciled it, and I've prayed to God. I say, God, if I need to be shown something different, show me something different. But my fiduciary responsibility to the biblically responsible investor versus the, can I say, secular investor, they're different responsibilities, and I've got to honor both and do it well.
Okay, Bob, I get this question with each passing year more and more, and I think it may be a function of my hair turning gray more and more. What are your retirement plans?
So when I left BlackRock 6 years ago, some of you know there were push and pull reasons. Among the things, I looked in the mirror and I said, you know, I'm managing a boatload of money, talking about markets, and I'm running a business, and I have 2,000 people reporting to me. Bob, you are mortal. You're not going to be able to do this forever. Now I'm at Nuveen, and I'm managing money, less than I did before, and we're hoping to grow it. I talk about markets. You just saw that in small action. And I manage not 2,000 people, 2. One of them is my assistant, as my wife reminded recently, you don't manage her, she manages you. So I guess I manage one person, my number 2. I could do this a lot easier. So my honest answer is, unless God writes in the sky differently, my view, having spent a lot of time on calling in the interim period between jobs, is God has wired me, called me to this business, and I will do it as long as it gives me health here and here. So I could do this for a long, long time and hopefully serve Him better and better each year. And we all have to come to grips. That's, that's not the answer for everybody. I do believe the word retirement is not in the Bible. And while we might retire from one thing and move to the next thing, we do not retire to put our feet up. Might we take on something that's fewer hours than we did before because we have other things in life? Absolutely. I'm not stepping on people who legitimately, in fact, I retired from BlackRock.
More question for you, Bob. Talk a little bit about active versus passive management, especially in a world where you have the top 5 companies of the S&P 500 making up about 14% of the market capitalization weight. And what kind of value an active manager can add to, especially in today's environment versus, say, 2009?
So I will qualify my answer by reminding people I am an active portfolio manager. So I'm very biased on this score. I think the people that want us to ask the active versus passive question are primarily passive firms. To me, the question is not active versus passive. It's how do I position my clients and active managers that are likely to win and avoid active managers that are likely to lose, whether it's this many active outperforming or this many. And there are, I won't bore you with the research, 3 characteristics for predicting which managers are likely to win. One of them is not past performance. It's active share, size, small beats big, and manager ownership. The more manager owns, the higher, the better the fund tends to do. So you can position yourself no matter how few active managers are winning. Now, to more the point of your question, the percentage of the top 5 today is the same as it's been on average. Yes, it's up from its low, but it's about reached its average. So concentration in this market, really not happening. It's a very broad market. I guess I give a couple other points. We've obviously not tested the holders of these passive products with a notable bear market. We've had short periods. I meet financial advisors who say to me, Bob, I use index funds because they're safe. Yeah, I hear that giggle. I agree with you. Safe from what? The market's going down 20%. I know how much you're down. You're down 20%. You don't have a chance of only being down 12. The other thing I said, and I hope I'm not stepping on too many toes, is I do not understand how a financial advisor, in his or her good conscience, can use a passive fund or an ETF. Because when you buy those products for your clients, you are consciously subjecting them to bad stocks. My view is your responsibility is at least try to be in good stocks and avoid bad stocks. Use those products, you're deliberately saying, I'm giving you bad stocks. That's me, sorry. My financial advisor said to me not too long ago, do you want to have some ETF exposure to a certain... I said, if you ever use that word in front of me again, I'm going to fire you. So again, I'm very biased and I hope haven't stepped on any toes, but my job as an active manager, I'll end on this, is gotten easier. My alpha in my 5+ years at Nuveen is about 50 basis points per annum higher than it was before. And we've tried to analyze why, and I think it comes back to it's easier. So many people are using these brain-dead benchmarks to invest in without having the opportunity. And I said, fees. We'll put our, I'm going to give an advertisement now. We'll put our large cap core fund against any big large cap core fund, index or not, post fees and post taxes. That's what investors have to care about. It's sort of like, well, my clients want me to have the lowest fees. Well, if you got a brain tumor this afternoon, are you going to call and say, can you give me the cheapest brain surgeon? You're just not going to do that. You're going to say, give me the best brain surgeon. I feel another sermon coming on. Thanks, everybody. God bless.